Before we get into the data, let me say what I say at the start of every single video. This channel has no advertisers, no broker partnerships, and no financial institution paying to be here. Everything you are about to hear comes from primary source documents, irs.gov, IRS Topic 409, Revenue Procedure 92103, the Internal Revenue Code itself, and State Tax Foundation filings. Not Reddit threads, not YouTube opinion pieces, source documents. If you want to verify every number I give you, the sources are in the description below, and I encourage you to do exactly that. Now here is why you need to stay with me for the next several minutes. Silver has had one of the most extraordinary price runs in modern memory, from under $30 an ounce in early 2025 to a historic high of $121.67 on January 29, 2026. Even after a significant correction, the metal is still trading in the $79 to $81 range as of early May 2026, more than double where most long-term holders bought in. That means a substantial number of people are sitting on very large gains, and here is the problem. Most of those people assume their silver is taxed like a stock. It is not. It is taxed like a painting, or a rare coin, or a bottle of vintage wine. And the difference between those two tax treatments can cost you tens of thousands of dollars on a single transaction. As an analyst who monitors the intersection of precious metals and tax law, I have seen how these overlooked provisions of the Internal Revenue Code can wipe out a decade of gains in a single filing. Today we are going to fix that blind spot. We are going to cover 3 major frameworks, each one containing legal exposure that most silver holders never see coming. Stay with me, because this is not theoretical. This is your money. The first framework is the most foundational and the one that surprises people the most: the classification of silver as a collectible under the Internal Revenue Code. Under IRC Section 4 Jos 8M, physical precious metals, including silver bars, silver rounds, and most silver coins, are classified as collectibles for federal tax purposes. The IRS makes this explicitly clear in Topic 409, which you can read directly on irs.gov. I have linked to it in the description. Here is what that classification means in practical terms. If you bought silver and held it for more than 1 year before selling, your long-term gain is not taxed at the standard 15 or 20% long-term capital gains rate that applies to stocks or equity ETFs. It is taxed at a maximum rate of 28%. That is the collectibles rate, established and maintained under the current tax code, and it applies specifically to assets in this category: art, antiques, coins, stamps, and precious metals. This 28% is a ceiling, not a flat rate for everyone. If your ordinary income tax bracket puts you below 28%, your long-term collectibles gain is taxed at your lower rate. But if you are in the 32, 35, or 37% ordinary income bracket, which applies to more silver investors than you might think, especially after a year of strong gains, you are capped at 28% on the long-term gain. That cap is actually a slight benefit compared to your ordinary rate, but it is still significantly higher than the 15 or 20% rate you would pay on a stock held for the same period. Now here is the piece that genuinely surprises people. If you held your silver for less than 1 year before selling, you do not get the 28% rate at all. You get taxed at your full ordinary income rate. That can be as high as 37% for high earners in 2026. So the short-term rate on silver is not capped. It is your full marginal rate with no ceiling. Let me give you the concrete math on what this costs you. Suppose you bought 500 ounces of silver in 2023 at an average all-in cost of $28 per ounce. You paid spot plus a 10% premium plus $200 in shipping and insurance. Your total acquisition cost was $15,600. Today you sell those 500 ounces at $80 per ounce and receive $40,000. Your gain is $24,400. At the standard long-term stock rate of 15%, your federal tax bill on that gain would be $3,660. At the 28% collectibles rate, your federal tax bill is $6,930. That is $3,113 more on a single transaction, simply because of how the IRS classifies the asset. At the highest bracket short-term rate of 37%, if you had held less than a year, you owe $9,028. That is nearly 37% of your entire gain gone before you account for any state taxes. I've spent considerable time cross-referencing IRS Topic 409 with actual dealer reporting practices to bring you the truth that most brokerage firms simply ignore, because brokerage firms handle stocks and bonds. They are not equipped to counsel you on the specific collectibles rules that apply to your physical silver stack. Stay with me, because this next part is where the legal exposure actually begins in a way many people do not anticipate. Cost basis is where most silver investors make their first serious mistake, and it costs them in 2 directions. They either calculate it too low and overpay their taxes, or they fail to document it properly and cannot prove their basis to the IRS at all. Here is the correct way to calculate your cost basis in physical silver. Your basis is not the spot price you saw on the screen the day you bought. Your basis is your full acquisition cost. That includes the spot price at the time of purchase, the dealer premium, which can range from a few percent on large 1,000-ounce bars to 15 or 20% on certain coins. Shipping costs, insurance during transit, and any storage fees if you consider them part of the acquisition rather than ongoing holding costs. The IRS allows you to include all of these as part of your cost basis. This matters enormously in today's market. If you bought American Silver Eagles at $35 each when spot was $29, a $6 per ounce premium, and you only record the $29 spot price as your basis, you are paying taxes on $6 per ounce of gain that was never actually a gain. It was just the premium you paid at purchase. That premium was real money you spent. It is part of your cost. Many of you have asked me how to exit your position safely. Proper cost basis documentation is the most overlooked piece of that answer. Keep every receipt, every invoice, every shipping confirmation, every insurance certificate. If you bought silver in multiple transactions over multiple years at different prices, the IRS allows you to use specific identification. You choose which lots you are selling. This means if you have some silver bought at $25 and some bought at $60 and you are selling today at $80, you can designate the $60 lots as the ones being sold and reduce your taxable gain accordingly. But you must have the documentation to support that designation. Without it, you are likely required to use a first-in, first-out method, which could force you to recognize larger gains from your earlier, lower-cost purchases. There is also an important distinction for inherited silver. When you inherit physical precious metals, the cost basis is generally stepped up to the fair market value on the date of the original owner's death. That step-up can eliminate the capital gain on years or decades of prior appreciation. If you have inherited silver and are considering selling, verify the date of death value carefully. It can dramatically reduce your taxable gain and is a legitimate code-supported tax benefit. The second major framework is what I call the reporting trap. And stay with me here, because there is a widespread misconception in the silver community that causes people to believe they have more privacy than they actually do. The misconception goes like this. If I sell my silver in quantities below the 1099-B reporting threshold, the IRS does not know about it and therefore I do not have to report it. This is legally incorrect, and acting on it is tax evasion. Let me explain how the reporting system actually works, because it is more nuanced than most people describe it. Form 1099-B is the IRS form that precious metals dealers are required to file when certain thresholds are met. For silver bars and rounds with a purity of at least 0.999 fine, the dealer reporting threshold is 1,000 troy ounces or more in a single transaction. This comes from Revenue Procedure 92-103 and has been confirmed by the National Coin and Bullion Association through direct correspondence with the IRS Office of Chief Counsel. For 90% silver U.S. coins, the pre-1965 dimes, quarters, and half dollars that many stackers hold, the reportable threshold is a face value of $1,000 or more. American Silver Eagles, as legal tender coins issued after the original 1980s reporting list, are not subject to 1099-B dealer reporting regardless of quantity. Now here is the critical legal point. The absence of a 1099-B does not eliminate your tax obligation. It never has. The 1099-B is a dealer reporting requirement that helps the IRS cross-check returns. It is not the trigger for your legal obligation to report gains. Your obligation to report every taxable gain arises under the Internal Revenue Code itself, independently of whether a dealer files any form at all. In my proprietary modeling of silver price cycles, the tax drag is often the silent killer of net returns that investors fail to calculate in their planning. Selling 200 ounces of silver bars at $80, a $16,000 transaction, may not trigger a dealer 1099-B. But if your basis in those 200 ounces was $30 per ounce, you have a $10,000 gain that belongs on Schedule D of your Form 1040. Full stop. The IRS has also significantly expanded digital payment reporting in recent years. If you sell silver through online platforms that process payments, think peer-to-peer marketplaces, PayPal, Venmo, or eBay, those platforms now issue Form 1099-K for gross payments above certain thresholds. This effectively brings more silver transactions into the IRS's visibility regardless of whether the precious metals dealer files anything. Form 8300 is a separate and equally important reporting mechanism. If a precious metals dealer receives $10,000 or more in cash, and the IRS definition of cash here includes not just physical currency but also traveler's checks, cashier's checks, money orders, and bank drafts of $10,000 or less individually, The dealer is legally required to file Form 8300 within 15 days. Bank wire transfers and personal checks are not considered cash for this purpose. This is an anti-money laundering requirement under the Bank Secrecy Act, and it is strictly enforced. The bottom line on reporting is this. The system is designed so that large transactions are reported to the IRS, and smaller transactions still require you to self-report. There is no legally compliant path to selling silver at a profit without reporting the gain on your federal return. The third framework is one that catches sophisticated investors off guard. People who thought they had cleverly avoided the collectibles classification by owning silver through an ETF rather than physically. This is the Grantor Trust trap. The iShares Silver Trust, ticker SLV, and Sprott Physical Silver Fund, ticker PSLV, are two of the most widely held silver investment vehicles in the market. They trade on exchanges just like stocks. You buy them through your standard brokerage account. Your broker account statement shows them next to your tech stocks and index funds. Many investors assume they are taxed the same way. They are not. Both SLV and PSLV are structured as grantor trusts under U.S. federal tax law. A grantor trust is not a regulated investment company, which is what your typical stock ETF is. A grantor trust holds physical silver on behalf of shareholders. Each share represents a fractional ownership interest in actual metal, and because of that structure, the IRS treats gains from selling these shares identically to gains from selling the underlying physical silver. This is stated directly in the official prospectus and tax FAQ documents for GLD, the gold equivalent fund, and by extension applies to SLV. The relevant language, gains recognized by individuals from the sale of an interest in a trust that holds collectibles, are treated as gains recognized on the sale of collectibles, to the extent the gain is attributable to unrealized appreciation in the value of the collectibles held by the trust. That language is from SPDR's own January 2026 fund FAQ document. In plain terms, if you hold SLV in a taxable brokerage account for more than a year and sell at a profit, you owe the collectibles rate of up to 28%. Not the 15 or 20% long-term rate you would owe on a stock or a standard equity ETF. My mission with this channel has always been to provide raw, unvarnished data, even when it challenges the narrative that certain products carry no hidden costs. SLV is not a fraud, it is a legitimate financial product. But its tax treatment is materially different from what most investors assume when they first purchase shares. There is an additional nuance specific to Grantor Trust ETFs that creates a small but real ongoing tax complication. To pay its operating expenses, the trust sells a small fraction of its silver holdings each month. Because you as a shareholder are treated as the direct owner of your pro rata share of the trust's metal, those microdispositions flow through to you as taxable events. The trust reports this on an annual basis, and it shows up in your 1099 as a small distribution or capital gain, often described as a return of capital adjustment. The amounts involved are typically small, but they do require proper tracking of your adjusted basis over time. The one major structural exception to be aware of: ETFs that are not structured as grantor trusts and do not directly own physical metal, such as certain mining company ETFs or futures-based funds, are not subject to the collectibles rate. They hold securities or contracts, not physical metal, and they are taxed under standard long-term capital gains rules. The difference in how a fund is legally structured is the entire ball game from a tax perspective. If you currently hold SLV or PSLV in a taxable brokerage account, this does not mean you should sell immediately. That decision depends on your specific tax situation, your holding period, your cost basis, and your income level. What it means is that you should know exactly what rate you will owe before you make that decision, rather than discovering it at tax time. Now let us move into the 5 legal strategies for managing your silver tax position in 2026. These are not loopholes. They are provisions of the tax code that apply directly to your situation, and every one of them is fully documented. The first and most powerful structural tool for new or ongoing silver investment is the self-directed IRA. Under IRC Section 408(3), certain precious metals held in an IRA are not treated as collectibles for purposes of the prohibited transaction rules, provided they meet specific purity and custody requirements. Silver held in a self-directed IRA must be at least 999 fine and must be stored in an IRS-approved depository, not in your home, not in a personal safe deposit box. Commonly used depositories include Delaware Depository Service Company in Wilmington, Delaware, and Brink's Global Services facilities in Los Angeles and Salt Lake City. Personal possession of IRA-owned metals is a prohibited transaction under the code and would result in the entire IRA being treated as a taxable distribution in the year the violation occurs. The tax advantage of holding silver in a traditional IRA is significant. Gains grow without being taxed annually, and you do not owe tax on appreciation until you take distributions in retirement. In a Roth IRA, properly qualified withdrawals in retirement are tax-free entirely. The 2026 IRA contribution limits are $7,500 for individuals under 50 and $8,600 for those 50 and older, provided contributions do not exceed earned income. Rollovers from existing 401k accounts are another common funding mechanism and are not subject to the annual contribution limits. The second strategy is tax loss harvesting, and silver has a specific characteristic that makes it superior to stocks for this purpose. There is no wash sale rule for physical precious metals. The wash sale rule, which applies to stocks and securities, prohibits you from claiming a tax loss if you repurchase the same or a substantially identical security within 30 days before or after the sale. Physical silver is not a security under IRS Section 1091. It is tangible personal property classified as a collectible. If your silver position is currently at a loss relative to your cost basis, which is entirely possible for positions opened near the 2026 high of $121, you can sell those holdings to realize the loss, immediately repurchase silver at the same or similar price from a dealer, and use the recognized loss to offset capital gains from other investments in your portfolio. Stocks, bonds, real estate gains, and even other collectible gains can all be offset dollar for dollar by capital losses from silver. This strategy requires careful documentation but no waiting period. The loss is captured on the date of sale. Your new basis resets to your repurchase cost. If you are carrying large gains from other parts of your portfolio in 2026, this is worth a serious conversation with your tax professional. The third strategy involves strategic timing of sales across tax years and income brackets. Because the collectibles rate is capped at your ordinary income rate if that rate is below 28%, there is a real benefit to timing large silver sales during years when your total taxable income is lower. The standard long-term capital gains tax rate of 0% applies to individuals whose income falls within certain thresholds. In 2026, for example, a single filer can have up to approximately $48,350 in taxable income and pay 0% on long-term capital gains from standard investments. Collectibles gains do not qualify for the 0% rate, but they do benefit from your lower ordinary rate if you are below the 28% bracket threshold. Spreading large liquidations across multiple tax years can materially reduce your aggregate rate. The fourth strategy is the state-level picture, which varies significantly and has changed meaningfully for 2026. Two states are particularly noteworthy. Missouri eliminated all state capital gains taxes on specie, coins and currency made of precious metals, effective January 1, 2026 through the passage of HB 754, combined with Missouri having already eliminated its general state capital gains tax effective January 1, 2025. Missouri residents in 2026 have zero state capital gains exposure on silver sales from either general gains or the specific specie classification. Iowa eliminated the state capital gains tax on bullion coins and currency under House File 659, effective for tax years 2024 and after. Iowa's individual income tax rate also dropped to a flat 3.9% in 2026 on other income. Iowa residents who sell silver at a gain in 2026 owe no Iowa state tax on that specific gain under the current exemption. These are legislated, documented state exemptions, not planning opinions. If you live in one of these states or are considering moving, this is a real and quantifiable tax benefit. A number of other states are actively considering similar legislation, and the trend since 2020 has been toward broader precious metals tax exemptions at the state level. A note of caution on state taxes generally: state tax law changes frequently. Washington State, for example, repealed its precious metals sales tax exemption effective January 1, 2026, the opposite direction from Missouri and Iowa. Maryland did the same in 2025. Always verify your current state's rules through your state revenue department or a qualified local tax advisor before making any sale. The fifth strategy is the step up in basis at death, which I mentioned briefly but deserves its own emphasis for estate planning purposes. Under current federal tax law, when someone inherits an asset, their cost basis is generally stepped up to the fair market value of that asset on the date of the original owner's death. For silver that was purchased at $10 an ounce and is now worth $80, the inheritor's basis is $80, not $10. All of the appreciation during the prior owner's lifetime is effectively forgiven for capital gains purposes. The estate may owe estate taxes if the total estate exceeds the federal exemption threshold, but the capital gains on prior appreciation are eliminated. For investors with substantial positions in physical silver who are approaching retirement or thinking about estate planning, holding rather than selling may provide a generational wealth transfer benefit that exceeds what any active strategy during life could achieve. This is a legitimate, code-supported mechanism that has been part of the tax code for decades. Discuss it with an estate attorney and a CPA who understands physical asset planning. Let me bring this together with the numbers that actually matter for your 2026 planning. If you are a high earner, married filing jointly with income above $250,000, your silver gains in 2026 are subject to 3 layers of federal tax: the 28% collectibles rate on long-term gains, plus the 3.8% net investment income tax, for a combined federal rate of 31.8%. Add in most states' capital gains treatment, and you are looking at an effective total rate above 35% on long-term silver gains for many sellers. That is meaningful, and it is more than most people budget for when they decide to sell. For silver held less than 1 year, the picture is even more severe. Short-term collectibles gains are taxed at your full ordinary income rate, potentially 37% at the federal level, plus the NIIT if applicable, plus state taxes. The question I get more than any other is this: does any of this apply to American Silver Eagles specifically? The answer requires a careful distinction. American Silver Eagles are explicitly carved out from the 1099-B dealer reporting requirements. Dealers do not file a 1099-B when you sell Silver Eagles back to them, regardless of quantity. That is a reporting distinction. It is not a tax distinction. When you sell American Silver Eagles at a gain, you still owe the collectibles tax rate on that gain. The exemption from dealer reporting does not create an exemption from the underlying tax obligation. Reporting and taxation are two separate and independent mechanisms. I want to be direct about one more thing before we close. This material is not investment advice and it is not tax advice. The 5 strategies I outlined above are real provisions of the tax code, but their application to your specific situation depends on your income, your holding period, your state of residence, your filing status, and dozens of other facts that only your qualified CPA or tax attorney can analyze properly. What I have given you today is the framework, the vocabulary and the structures, so that when you walk into that conversation, you are not starting from zero. Here is what I want you to do after this video. Pull your purchase records. Every receipt, every invoice, every wire transfer confirmation from every silver purchase you have made. Calculate your actual cost basis using the full acquisition cost, spot plus premium plus shipping plus insurance. Cross-reference that against today's spot price and determine what your gain or loss position actually is right now. Then go to irs.gov and read topic 409 directly. It takes about 4 minutes. The language is plain. It will confirm everything I have told you today. Then go to your state's Department of Revenue website and verify the current capital gains treatment for precious metals in your state. Do not rely on information that is more than 6 months old for state tax rules. They change faster than federal law. Then call a CPA who specifically handles precious metals taxation. Not a general tax preparer who does W-2 returns. Someone who understands the collectibles framework, Grantor Trust reporting, and the wash sale rule exception for physical assets. Sources for this video include IRS Topic 409, IRC Section 408M, Revenue Procedure 92103, Kiplinger's Capital Gains Tax Rate Guide updated for 2026, the Tax Foundation's 2026 State Tax Changes Summary, Sprott's official PSLV Tax Guide, the GLD January 2026 Fund FAQ document from SPDR, the National Coin and Bullion Association's reporting guidance, and the JM Bullion and APMEX reportable transaction disclosures. All of those links are in the description. The silver market has given long-term holders extraordinary nominal gains. The tax code determines whether those nominal gains translate into real, after-tax wealth. The gap between those two numbers is not small. It is the difference between a successful decade and a costly surprise on April 15th. Invest with logic, never with noise.